The ratings of Allahabad Bank's Tier 2 bonds are linked to its long-term issuer rating, which reflects the bank's systemically important position and our expectation of continuous support from the Government of India. The support stance is driven by Government of India's majority ownership in the bank, which was around 67% as at end of June 2016. The government has also infused equity to the tune of 10.2 billion over the last 12 months. Allahabad Bank continues to remain the 11th largest public sector bank in India by asset size, and if we factor in our growth estimates for the bank over FY19, the bank's systemic importance continues to remain intact. Over the last 5 years, Allahabad Bank has been able to maintain its CASA market share, and the bank continues to remain a mid-sized public sector bank with the highest CASA ratio of 37.4% as of June 16. The strong CASA franchise is premised on the strong legacy along with a focused strategy of opening branches in the right geographies. Allahabad Bank's asset quality has deteriorated with its gross non-performing asset ratio more than doubling over the last 3 quarters. The bank remains vulnerable to asset quality pressures in view of its sizable exposure to stressed sectors along with its legacy concentrations, which will remain an overhang in the near term given the sluggish pace of economic recovery. Our estimate of credit cost for the bank is in the range of 190 to 200 basis points for FY17. On the capital front, the bank would continue to require capital injections from Government of India to support loan growth and meet the minimum capital requirement over the Basel III transition period. We estimate Allahabad Bank will need around 52 billion of Tier 1 capital through FY19, which is around 41% of its CET capital as of June 16. Despite the impact of low growth and high credit cost on internal accruals for public sector banks, we continue to expect, even under stress case scenario, that the potential equity requirement or the bailout cost to avoid approaching the point of non-viability to be manageable. Consequently, the support floor for our long-term issuer ratings, which is used to benchmark senior bonds and Basel III Tier 2 instruments on public sector banks, remains unchanged.